You're 29 and you're good at your job. Your director trusts your numbers implicitly. You cover mid-cap industrials for a $4.2 billion fund. You own 8 of the 60 positions. 6 a.m., you're the first one in, reading earnings releases that the market just skims. You believe the market is a mechanism for price discovery. Your job is to find the error. That belief is about to be corrected. A Tuesday in October, a number you don't recognize. The voice is calm. Garrett Whitmore. He represents a family office managing $3.1 billion. They hold 22% of Arden Industrial, one of your 8. He wants to meet before Friday. The West Loop, no signage. The elevator requires a key card. You press it against the reader. Whitmore is mid-50s, silver temples. He pours 2 glasses of water without asking. He sets a folder on the table. Inside, your last 3 quarterly notes, annotated in blue pen. Arden was bought 11 years ago at $4.12. Today, it trades at $31, a 600% return. You say, why not sell? Basic portfolio management. Whitmore looks at you like a novice. Federal gains at 20, Illinois at 4.95. A sale means $80 million in tax permanently. Whitmore slides a term sheet. A $190 million lending facility, 3.4% annually, no tax. Liquidity is borrowed into existence. The asset continues to compound. They never sold. You were quiet for a long time. Whitmore says, we never have to find another security again. You take the engagement. Your education begins. The first year is purely technical. Real estate held through LLCs, each one a separate, impenetrable legal container. Equity held in a trust designed to step up cost basis at death, a shield for heirs. Embedded gains eliminated. The government never sees the appreciation of the asset. Carried interest taxed as long-term gains. Every asset chosen for its character and tax status. This is not a portfolio. It is a machine designed to generate spending power indefinitely. You model it at 11 p.m. alone, comparing the sell versus the hold reality. Scenario 1, pay the tax and reinvest at 8%. The balance is $100 million. Scenario 2, borrow at 3.4% and retain the position and let it compound forever. You run it forward 30 years. The gap is not incremental, it is generational. $340 million more. Not from a better investment, the return assumption is identical. The only difference is what they refuse to pay. The math is brutally obvious. You understand why they don't teach this. This is what they built, and now you are inside it. The architect of forever. The game moves to year 2. The government never sees the gain. The appreciation is locked in a vault of time. Scenario 1, the family sells Arden, pays the tax, and reinvests at 8% annually. Scenario 2, borrow at 3.4% and retain the position and let it compound forever. You run it forward 30 years. The gap is not incremental, it is generational. $340 million more. Not from a better investment, the return assumption is identical. The only difference is what they refuse to pay. The math is brutally obvious. You understand why they don't teach this. This is what they built, and now you are inside it. The architect of forever. The game moves to year 2. Year 2. Permanent income. Water utilities. Cell towers. These assets breathe cash. Income that cannot be stopped, regardless of markets, regardless of interest rates. A patriarch is offered $680 million. He doesn't ask the price, he asks about the leverage. Selling is not a transaction. Selling is an ending, a permanent claim traded for cash. The wealthy do not sell, because selling is the worst thing you can do with an asset. You walked in thinking about exits. You walk out thinking about forever. By year 3, you are building, a tech founder with $1.4 billion in one position. You use exchange funds, a solution of deferral. Legal fees alone, $2.4 million. Leverage is a tool for liquidity, creating value from the illiquid without selling. The assets are not a stack, they are a lattice. Each one supports the other. By year 3, the shift is absolute. You are no longer watching the ticker, you are the ticker. In Chicago, the air is different. It smells like data and old mahogany. $4.2 billion under management. The first rule of the elite: never use your own cash. Use the bank's fear as your fuel. Recourse versus non-recourse. One chains you to the floor, the other sets the asset free. You bridge the gap, a $400 million bridge loan, 18 months of breathing room for the empire. The interest is tax deductible. The growth is yours. The IRS is a spectator, not a partner. You meet the titans, men who own the dirt under the skyscrapers. They don't talk about ROI, they talk about basis points. To them, 10 BPS is the difference between a jet and a car. A private equity firm calls. They want your dry powder. $1.2 billion waiting for a war. You deploy, not into stocks, but into infrastructural necessity. Toll roads, prisons. People must move. People must pay. Your income is now a fundamental law of physics. Ohio is a dream now, a gray memory of cubicles and lanyards. You have evolved. The math of the 99% is addition. The math of the 1% is exponential multiplication. You learn the step up in basis. Death is not an ending. Death is the ultimate tax shield. Inheritance is a transaction of power. 0% tax. $2 billion moves without a sound. The world is on sale. Interest rates rise. The weak sell. The operator buys more. Distressed assets. A shopping mall in decay. You see a data center in waiting. The conversion cost, $90 million. The projected value, $450 million. This is the invisible gap.
You don't need luck. You need the information asymmetry, knowing what they don't. Your network is now your fortress. One phone call solves a $100 million liquidity crisis. Wealth is boring. It's just spreadsheets and patience. The thrill is for the poor. A market crash happens, the news screams panic. You pour another scotch. Volatility is your friend. It shakes out the tourists. It leaves the owners standing. By year 4, the portfolio is a living, breathing organism. It feeds itself. Each asset pays the interest on the next, a perpetual motion machine of capital. The IRS agent looks at your returns, $0 tax. He knows it's legal. He hates the game. The game is not about having more. The game is about needing less from the system. And then the phone rings again. An activist investor wants your crown jewel.
Year 4. The activist investor wants a sale. Logical logic, price discovery. But you are no longer on that side. A sale means $260 million in taxes.
You build the defense. REIT restructuring, leveraged dividends. The family keeps the city blocks. The city remains. Wealth is the refusal to subtract. Cash is inert. An asset is alive and compounding. The family that borrows does not pay. The tax code responds to your structure. Every wealthy family has an architect. Most people don't know the architect exists. An offer for $2.8 billion arrives. You are threading the needle between IRS and growth. The IRS has been watching for 18 months. A similar structure was challenged. The outcome is unknown. You are building something that might not hold. You build it anyway, encoded into family policy. 4 generations, we do not sell. The markets open tomorrow. Tax Council answers in 3 weeks. The clock is alive. You hold the map. You do not own the toll roads. You do not own the city blocks. Another family is waiting. Another position. Another embedded gain. The cycle repeats. The wealthy don't sell because they don't have to. They've transcended the exit. Asset is greater than cash. Loans are not taxable. Compounding is relentless. The architect's secret. Never subtract, always add.